right, a year ago on February the 2nd, we had earnings from Amazon, Facebook, Google, Apple that all did really well, and the market did very well, gapped up to the upside, had a big move, and then that ended up being a short-term peak that ultimately led into the banking issues that we had last March. The next day was the jobs report last year, a year ago, on February the 3rd. Yields took off. That sparked a rally in yields. Yields took off to the upside. Fast forward a year later, 2024, February the 2nd, happens to be the same day that we get these earnings and the jobs report. And are we going to get the same move, right? So far, on the day of, we have. And we'll see if we ultimately, from Monday going forward, so that's kind of going to be the crux of the discussion here today. How things look, what we expect to see now, and are we likely to see this similar type of reaction to significant gaps at the upside in Amazon and Facebook, and how they ended up being filled last time, which sparked the peak in the broader market following this, an increase in yields from a very strong employment report. Are we going to see something similar this time? So we're going to break all that down in today's video. Our trade idea stock that broke out itself. We'll talk about how to trade that in a different sector than what you'd expect. So let's go ahead and get started. Today is Friday, February the 2nd, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video that we do, where we follow up on all the trades that we do in these videos and see whether we should get out of them or stay in them. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. That pops up. There we go. And also same thing here. Click that thumbs up icon. It opens up another new tab. Hit that like button there. Again, the more you do that, it helps us get our content out on these platforms to all of our followers on these platforms. That's why we always ask for it. It's a really big deal for us. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. And we'll take a look at how we finished Friday. Almost a cluster. You had the momentum line just barely above the 80th percentile, and the near-term line, the blue line, just barely below the 80th percentile. So because of that last little drop off of the right into the close, just that barely little drop into the close, you had you avoided a cluster by that much, right? It was that much here. You avoided the cluster by. So, and that would have had all four lines. Now, interestingly enough, and I'll make this comparison a lot here today in the video today, but if you go back to last February the 2nd, over here, was also the day that you had earnings announcements from major Magnificent Seven companies, Amazon, Meta, Apple. We gapped up. We went significantly higher. You came within a hair of a cluster there too. Now, not with the market sentiment, but it still would have been a cluster with the momentum line just barely below the 80th percentile. So very, very similar reaction here to the market this February the 2nd as we had last February the 2nd. Now that February the 2nd, we were not as bullish for as long. We were just starting, but that ended up being the peak of earnings that day. We've been a lot more bullish this go around, and we'll see if this one ends up being the peak. Very similar again, like I said, to last February the 2nd. If you take a look at the NASDAQ 100, it was also had a cluster during a part of the day, but then finished without it by the end. The near-term line down to the 70th percentile. The momentum line did stay up. But you can see, again, everything in bullish levels there. This is in contrast to the Russell 2000, which is actually showing dark pink shading and a red line. Its near-term line is not above its intermediate line. Its intermediate line is falling below the 50th percentile, which is why you have the dark pink shading. We've been below the moving average now multiple days, which is why it's now red and falling. And the intermediate line's been below market sentiment this entire time. Remember, on the S&P 500, even though they're both in the upper reversal zone, the intermediate line is kind of sitting right on top of the market sentiment line, so just barely above it. by like 900ths of a point. So this is a big contrast between the mega caps influence in the S&P 500, and then of course the fact that there's very little influence on the mega caps, because it would obviously be all indirect influence on the Russell 2000, as we are nearly 1% below and appearing to be rolling over, getting a bull tag and not really kind of bouncing off of that bull tag there. Of course, your Dow Jones Industrial Average, when you look at that, again, very similar, because it does have Apple and Microsoft in it, and it did finish the day with a cluster. And over its second cluster, the last cluster we got right before expiration, and then now another cluster here. So continuing, again, just reflects just how strongly bullish we are. Again, this is not, we don't know if this is the end of an intermediate trend, but we do know it's not the beginning of one, right? When the intermediate line just crosses, getting a cluster when the intermediate line just crosses above 80 is actually a really good sign. But when when the typical time frame is 1 to 3 months, and we are now 3 months into this one, to get a cluster now, excuse me, suggests we might be more towards the end of this than the beginning, right? Which obviously makes sense. Obviously, we're not towards the beginning, unless this ends up being another 11-month rally, which we had like in 2021, during a very liquidity-fueled move that we had, inflation-fueled move that we had that year, that ultimately spawned the 2022 correction because of how insanely bullish we were that year. Let's go to SPX and take a look at the weekly version of this. And you can see here on the weekly version of the market forecast chart. Sorry, it's a little slow right now. And you can see, again, remember, we're 2 weeks off of getting a cluster there, and we've gone even higher now. The near-term line still very strongly bullish. Momentum line dropping. Not surprising. A little bit of a bigger range, actually. Double the range what we had last week. A little bit of a lower shadow that we had that's kind of brought the near-term line down. If you notice, we are 9.5%. It's not in the 90th percentile yet above the moving average, but it is still pretty high. Again, if I were to zoom out for some perspective here and kind of give you an idea, if I put my cursor right where we're at here today, 9.5%, right in this area here, then you'll see that, outside of vaccine, post-vaccine, reopening trade, inflation-fueled run in 2021, liquidity-fueled run in late 2020, early 2021, where we really just poured a lot of money into the system. Outside of that, where we were well more than 10% above, this is, if you follow my curve, and again, coming off of bear market lows of 2020, and then that really parabolic peak we had in early 2018, this is a pretty decent level up above the moving average to be. So needless to say, again, that cluster kind of just reflecting just how strongly bullish we've been. Again, not the case for the Russell 2000. As you see here, if I zoom in, the intermediate line, like we have light pink shading now. We are still above the moving average by about 5%, but off of the peak of there. And then you can see the near-term line is actually still below the intermediate line. It had crossed below it up there, and it's now that the intermediate line is between 20 and 80. Anytime you're below it is bearish, not necessarily bullish. You have to be above it, like this instance here, to be bullish. So we're not necessarily the most bullish on this pattern. The momentum line is a lot deeper in bearish territory than we think. So, again, continuing a big discrepancy between the two major indexes, the large caps and the major index here for the small caps. If I were to go out to the 3 green arrows, no surprise here that we see 3 green arrows for the S&P, and remember the Dow Jones with its cluster. The Qs, there's in a little bit of convergence mode. We have a red arrow on the MACD. It's the only red arrow there. We had a red arrow on the MACD yesterday on the S&P. But again, your Russell 2000 actually shows 3 red arrows. So again, continues to be kind of defiant, right? I mean, we had a period of 3 red arrows over here, but at least the other indexes were in convergence mode, right, on all 3 of these, kind of at the middle of January in this area here. But the Russell 2000, again, kind of shows. It did not have that period of 3 greens like the other indexes have had, and is, like I said, already back to 3 reds with a red line, right? It's one thing to get 3 reds and have a yellow line because it's still rising, But now we have 3 red arrows and a red line, which is actually even more bearish than normal. So fascinating difference here between the two, as you'll see here as well. The S&P clearly up, new all-time highs again. MACD is up above its moving average. Stochastics is not above its moving average, but at least it is in the upper reversal zone. And again, looking at IWM, you can see we are below the 17-day moving average. The 8 and 17 are also below the 30-day still, as we're kind of filling in this gap between the 50. And then you can see the MACD cross back below. Remember, the 3 red arrows cross back below. It's still positive, barely, but it's crossed back below there. And your stochastics is also crossed back below its moving average. So you see the big difference there. Looking at some of these other oscillators, SPY on the DMI, you can see a very positive pattern above 30, below 20. So your ADX has stopped declining and is actually turning back around. Fueled, of course, by the Qs, which is pretty darn bullish itself. Again, not the case for IWM. Both lines are actually below 25. The positive line is actually below 20 for the first time in a while. This whole time we've been bullish, as again you have the pink shading from the market forecast and the red line with the 30-day moving average falling. The ADX has actually come all the way back down below 20. I mean, that's how much the trend has. We've lost the trend on the Russell 2000. You still have a very mature bullish trend on the S&P and the Qs for that matter, back to almost maturity after having lost its trend. The Dow is even more mature than the S&P, well above 16.5. For some context on being above 16.5, again, the only times that we've ever really been bullish, more bullish than this, is that insane bullish run we had at the end of 17, early 18, another big liquidity-fueled rally, and then that's it, right? You have to go back to 2006, after the Fed stopped raising rates, and I brought that up in the last Market Outlook video I did about that comparison between now and this period of time, end of the year going into the beginning of the year, when the Fed had stopped raising. They stopped raising rates in June over here. Of course, this year was July. And you can see the market really took off. And you can see, like, again, a year later, not so bullish on that. So kind of a similar, you can see that in the Dow, like just strong bullish move. Not the case in IWM. Again, no trend at all. And you're still like, you're barely holding on to that cloud. And the green line's still below the blue, and you got a way negative rate of change. So the trend is clearly not bullish anymore, at least, at the very least, on the Russell 2000. Your S&P, the RSI is positive. Your CCI is positive on the Russell 2000. Not necessarily the case. Both very neutral. So they're not bearish. So at least the Russell's not bearish here. At best, you could say it's neutral. It's not bullish anymore either. It's just kind of stuck there in the middle. As you can see, its weekly CCI is not dropped below 0 yet, but when it does, again, that's kind of another sign of weakness. That's not. We're closer to it on the Russell. You can see the S&P on the weekly chart on the RSI is actually above 70. Strong move. So again, reflects just how bullish we are. How many weeks is this? And we're like 13 out of 14 weeks. We've rallied up to the upside here. Again, you get a little bit of a divergence on the CCI, but at least it's still above positive 100. Again, getting below minus 100 is when I have to stop, when we have to like say, okay, now we're done with this green box. So let me get it all the way to today here. So that's when it would end, is when it crosses below 100. That's kind of when you've ended the bullish run. And we can start being a little bit more bearish. You can see this, how it started here at the beginning of 2022 with that week, right here from 29 there to minus 185. And then, of course, after some ups and downs, that kind of started the contraction level there. So, we're not to that point, clearly with an RSI that's as positive as it is. But again, you can see the divergence, and like I said, the Russell 2000 and where it's at right now. Looking at the Bollinger Bands and the Keltner channel, the S&P is well back above its channel. So it had gotten out back below it, is back up above it. Remember, we've been on this bullish run of momentum for quite a while with no consolidation, right? No bearish momentum in between. So we're just continuing this move back above the channel, almost back above the upper band to the 90th percentile. We were above the upper band at the high of the day. And then you can see the bandwidth has expanded again back up to similar levels that it did last expansion that it had. Looking at the 4-week range, you can see we did get a new 4-week high point, so you got another 100 level. Again, you can see the trend going here, and the single touch, again, as bearish as that was, the single touch you have here. As bullish as that is, excuse me, it's bearish when you get the single touch on the green line. It's bullish when you get the single touch on the red line, and then now we're back to zero, right? So we're back to zero. You have we've gone back up. Remember how we had been so bullish? It was so rare to go from below 5 to above 10 on a bullish move, but we did that, and then it came back. Not surprisingly, it came back down to very extreme low levels after the bullish run, which typically leads to consolidation. In this case, it did not. It actually led to a new move higher, back above 5%. Again, not to extremes though, but at least away from extreme lows on another bullish run. So just extending the parabolic move we have had, which again, it's hard to consolidate. It's hard to start a reversal from a parabolic move, as we saw in late 2017, early 2018. You saw how that parabolic move really went parabolic. So it's hard to start a reversal from a parabolic move. And it's just that once it does start, that's when it's, again, as painful as it is. But this kind of goes to show that you can continue a parabolic momentum even after a brief pause of convergence, not even consolidation, but just convergence, and continue continue on that same parabolic momentum that we had. And you see that there with the new highs. And again, you can see the kind of move from the lower half of the chart in the first half of this 4-week period pre-expiration to the upper half post-expiration. We've just been kind of sitting in this area until the breakout that we had today. Of course, the range and the volume the past couple days have been relatively strong. Sorry, let's go to this chart first so we can actually see what it was. So the range ended up being 6.75 points, so well above the average. And the volume again was above average. So we've had 3 days in a row of above average ranges at 6.22, 5.43, and 6.75. To the tune that the ATR has really kind of climbed here back above 4, right? Because it had been below before these 3 days. It was at 3.75. The actual absolute value of the ATR is 3.75. Had gone now after these last 3 days of Fed meetings and earnings and jobs numbers, we're back up to 4.4 points. So just like that, big move. And then the volume is ticking up with today's at 99, so way up here. So, and you can see the average, the normalized ATR had gotten down to 0.75% relative to the value of the index, now up to almost 0.9. So remember, when these rise, that's not necessarily the most bullish. It's actually kind of a bearish sign. So we'll see how much longer we can maintain this bullish momentum with such strong rallies. Ideally, we want to now start to, if we're going to stay bullish, we want to start slowing it down and getting back to, these, small numbers, like these kind of moves, really, really small moves, small ranges, small moves. That's the best way. If we continue with big ranges and big volume, then it usually doesn't, unless you're coming off of a major low where the ATR is actually pretty high and it's falling, that's kind of, it's you don't typically maintain bullish trends you typically exhaust bullish trends with those kinds of moves. And then finally, taking a look at the VIX, you see that the VIX is still pretty high, so very highly correlated with the VVIX. The VVIX is not as low as it's been, but still below like 85, still near in the low 80s. And the VIX itself is below 90%, below 15, so very, very low. But remember, the VIX is not low relative to its own average value. So it's still prone to moves to the upside because we are above its average values, except for the 200-day average. It's above all the other major time frame average values. And so, again, you're more prone to bullish moves. And now the 200-day average value is almost below 15 itself. So we are converging on volatility, basing and setting ourselves up with small ranges, because if you look at the range for the VIX, right, which is really the only way you can predict that we're gonna, that you're gonna get a big move higher in volatility. But as you can see here, the range for the VIX is very low, right? Very, very low. And that typically sets us up for bigger moves. You can see the last time we've been this low on volatility for such an extended period of time below this 10% mark was 2017. And again, that led to the first part of 2018 and really the rest of that year where volatility stayed very strong, ultimately culminating in the washout move there. So it kind of looks like we're setting ourselves up for that kind of move again, a very extremely low level of volatility, and VVIX for that matter too, is also really low, again in the low 80s, very similar to 2017. We had a ramp up in that right before 2018 at the end, and we'll see if we get something similar here, as it's actually pretty darn low itself right now. All right, now let's take a look at what's driving this price action. And you can see, again, the 3-month returns here, the Qs and the S&P and even IWM all up double digits in the last 3 months. Again, the biggest reasons why: yields are down, bonds are up, dollar is down, and commodities are down. That's the three-headed monster, and that's really providing some good leeway for the markets over the past few months here that we've been so bullish, had this parabolic move. Well, if you just look at what happened here on Friday, and just take a look, remember that we've had 3 days really of strong moves. Again, the Qs are the only thing that was up. The dollar was up strong. Again, this is coming after with yields up strong. The dollar was up really strong. That's 2 of the three-headed monster. The commodities were down. And so because of that, the Qs were able still to maintain a strong move higher. Very, very strong move higher. Remember, we've had 3 days down above average ranges and ranges because we had the earnings announcements Tuesday night and then the FOMC meeting on Wednesday. So this is really the 3 days. And over the past 3 days, again, bond yields originally dropped significantly before rebounding up, and bonds were actually still over the 3-day period were down. So they started down, they really went down, and then they rebounded up here until bond prices are up slightly. The dollar started down and was mostly down for the first couple of days before it rebounded. But look at commodities. Commodities down 3%, really dropping really hard. So let's take a look at those 3 things as they're so important to what's driving this price action. So let's pull up another chart here and take a look at, let's look at commodities first, specifically crude oil, which is a big component of that commodity basket. And looking, you see crude oil broke back down all the way down to the low 70s from really being close to breaking up above 80, breaking back down to the point of control, breaking below all of its moving averages, MACD and stochastics down. If you take a look at the commodity index, the full DBC, you can see it also broke down hard on Friday. Big gap down to the downside, pretty much at its 52-week lows again, just like that. If I were to go out a couple more years, you can see how it's been it's been a while since we've been this low, and MACD and stochastics rolling over. So pretty bearish for commodity prices, which usually means the dollar is coming down. But that's not the case. The dollar broke out in a big way on Friday. Big engulfing pattern, engulfing a lot of bodies there, closing above a lot of shadows. So a big breakout, above the 200-day moving average. If you take a look at the weekly chart of this, you can see it's been a gradual move higher for 5 weeks in a row this week. Finally closing above the 30. After closing above the 17-week last week, we closed above the 30-week this week. The MACD is above its moving average. That's why you got the positive histogram. The stochastics is now out of bearish territory. So you can kind of see we're just starting to move higher on the dollar. And then finally the third is bond prices or bond yields. Again, the rally in bonds has been positive for stocks because they've been positive. Remember, they're positively correlated here lately. When you look at bonds and stocks, a small positive correlation, especially when you look at the longer term view over the past 3 months. Let's go out 3 months here, and you can see again very strong correlation there. And that has been the case for the past few years because of the inflationary cycle we're in, right? Once you get to an inflationary cycle, then these two move together, right? And they don't in a deflationary cycle. And you can see here during 2023, bonds were dropping as stocks rallied. So it kind of broke up into the summertime, broke that pattern, and then they both dropped. So bonds ended up being way below its October lows from last year, even though stocks formed a low point that was way higher than its October lows. Imagine if they had maintained their positive correlation, stocks would be well below, the S&P would be well below that. But thanks again to the Qs, that hasn't been the case, because you can see, it had that negative correlation with the Qs. If you look at the correlation of bonds to the Russell 2000, not as positive, right? It hadn't been as positive until here just recently, when now it's up to 92% positive. But again, you can see we're a lot higher than the end of the year on the Russell 2000, though the bonds are not up to new highs. So you see how that correlation, you would expect, will start to break down here, break down in the wrong direction. So, those are, and again, we always talk about the breadth, and the breadth on Friday was really, really poor. We ended up being a negative on the McClellan oscillator for the second time of these 3 days. Even though the first day you say, okay, I understand why we're negative, because we were down. This day we were, forming clusters like on the Dow Jones. So, but we still ended up negative. So really, really poor breadth indicators. If you look at the new highs and new lows, something we look at a lot. Look at the skew. Skew jumped up above 160. I mean, that's a huge move on the skew to get up above 160. Again, the options market does not like the fact of how much we've really moved up here on the S&P. But you can see, like, we're sitting right at the average. So we're actually down on the new highs. Not negative, but we're down. But you look at the number of stocks above the 50-day moving average, way below its average. That's falling hard. The number of stocks above the 200-day moving average is actually higher. In fact, if you look at the ratio of the number of stocks above the 200 versus the number of stocks above the 50, it's been above its average for a while, which is usually bearish. When you see how when you get above the average, you see how the S&P gets lower. Same thing here. When you get above the average, it's actually relatively bearish here. And then it peaks at these lows. The ratio peaks when you're at the lows above 2, or at least above like 1.5, or somewhere around these higher levels. Well, we just barely crossed above 1. And so usually when you cross above 1, you are in the throes of an intermediate decline. We're not in the throes, we're at new highs. We're at all-time highs. We're at clusters. We're not in the midst of an intermediate decline, which makes this move really, really fascinating, which again goes to show, and you see that here as well, the ratio of the Qs relative to IWM itself closing above 2.2 for only the third time, the fourth time now, in 20 plus years, right? So we had that 3-day surge over here where the Qs, and then it obviously dropped off there in November, when last year's increase in the S&P was fueled by this, kind of the broadening out, the strong breadth that we had. That's not the case right now. Like, we're rallying this year, and it's all been the Qs. As you can see, it's been a big move higher. And in fact, if you were to go all the way back to the lowest point here, the lowest close that this ratio had was on December 27th of 2023. So if I were to go back here to December the 27th, or starting on December the 28th, the next day following of 2023. So we'll go 28. Fat finger, I can't hit things. Here you can see the Qs are positive, up 4% since that time frame. The dollar's been positive. Yields are positive. Commodities are down. The commodities were up, but you can see IWM is actually down 5%. The Qs are up almost 5%. IWM is down 5% since the time that this ratio is right. So the S&P is up, but you can see those are the only things besides the dollar that are up. So it goes to show again what kind of market we've had in this first month plus of the year. It's been largely fueled by what's going on in the mega cap, and specifically individual. I mean, not even all 7, right? It's been really just the major names. But you can see also when you look at their relative rotation graph, you're already starting to lose momentum in some of these names. Netflix is still going up, and Meta and Amazon had rebounds on Friday, which pushed them higher. But Apple's losing momentum, Amazon's losing momentum, Google and Microsoft are really losing momentum. Let's see, this would be Broadcom. There is losing momentum. Tesla's gaining momentum, but it's in the lower quadrant, so it has very weak relative strength. So you kind of get an idea that there's only 3 of these magnificent 10 in this case, because I've got Netflix and Adobe and Broadcom in here. But everything else is dropping right now, losing momentum. So we are heading into a peak with a cluster with all the main indicators, most of the 7 either losing momentum or has very negative relative strength. And that takes us to our sector. And we'll take a look at how the sectors have performed these past few days. And it shouldn't be a surprise to see which sectors are doing the best and which ones aren't. In technology, you can see XLY thanks to Amazon, XLC with Meta and Google. But Meta here on Friday, they're up big. Industrials, remember the Dow Jones getting the cluster, so industrials is up there. Financials has been up. Healthcare, Staples got a cluster here. But you can see some other areas like materials and energy not looking so hot with the strength in the dollar, right? They're putting pressure on those. Utilities and real estate not looking so hot either. So we're not bullish across the board, which is what's typical. You're not really even that bullish in Amazon. You just had one great day, and what we're hoping and what I expect actually, kind of like what we saw last February the 2nd, is that a lot of those gaps will actually get filled in. Most likely, that's like what happened last February 2nd. We gapped up to the upside in Amazon and Facebook, and then both those gaps got filled in relatively recently. In the case of Amazon, the very next trading session. Speaking of the energy sector, that's where our trade idea comes from for today, and that is Chevron. Chevron also had its earnings announcement here this week, and you can see the nice little pop it had on Friday. The intermediate line's rising in the bullish territory. That we're up 3% above the moving average. Got dark green shading in the green line. The near-term line almost crossing above the intermediate line there. So things looking a little bullish from that perspective. If you look at its weekly chart, the weekly chart there, you got the bullish candle as well. You can see the moving out, the PPO's rising. We got the transition candle. Now we're bullish. Got the green arrow. If you look at the 3 green arrow charts, we have 3 green arrows on. So this is all all the bullish signals were all playing out here. The DMI shows a bullish breakout pattern up above 30 on the positive indicator, below 20 on the negative indicator. The ADX is just now starting to rise, still below 20. Looking at the RSI and the CCI, you can see you're above 60 on the RSI, you're above 100 at least on the CCI. You'd like to get further. On the weekly chart, you've crossed above 100, so that's the start of a new bullish trend when you cross above 100 on that particular indicator. The Ichimoku cloud, we are into the cloud. The green line has just crossed the blue line, and then you have a flirting with a positive rate of change. You've been negative, now we're flirting with being positive here, and we haven't even started the bullish trend yet on that one. And then finally, from a Bollinger Band standpoint, you can see that we are in the upper quartile of bandwidth for the first time in a while, above the point of control. We were flirting with being above the Keltner channel. That's kind of what drew my attention to it initially. So what I decided to do on this trade was to do, again, because you do have some resistance up there, so I didn't want to be too aggressive. But at the time we bought the, it was the at the money call, sold 1 strike away for a long call vertical spread. So again, about a 2-to-1 reward to risk ratio, and then gives me some wiggle room for timing going into March expiration. We don't have to worry about earnings, and then of course I've got very small risk relative even to the reward of 2-to-1 here for a short time frame trade. Is a pretty low risk because of that. So willing to take even, and if we were to come back down below these moving averages, as you saw with the moving averages here, if we were to get back below like the 30-day moving average after this kind of breakout that we've had, then we'd obviously know that it's not going to make it to what we want to do, at least in the time frame that we wanted to do it in. So I'll probably end up taking a couple $100 loss, which really makes a $1,000 reward. Look, really good from a reward to risk standpoint, knowing that we probably won't even risk we probably won't end up losing the whole $500 that we're willing to, if this trade doesn't work out the way we expect it would. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.